$2 million in savings is not the finish line. It's where the real work begins. Now, most retirees hit that number and coast. They stop optimizing, stop planning, and then assume the portfolio takes care of itself. It won't. In this video, I'm going to show you the 3 pillars that are designed to keep a $2 million portfolio growing: income sequencing, tax strategy, and staying in growth mode. And I'm going to name exactly who's dropping the ball on each one. Why $2 million isn't enough on its own. Morningstar's most recent retirement research puts the safe withdrawal rate for a 30-year retirement at 3.9%. On a $2 million account, that's $78,000 a year before taxes, which is about $6,500 a month. That sounds fine until you actually map out what retirement costs: healthcare, property taxes, travel, the occasional repair that turns into a big renovation. For a lot of retirees, $78,000 isn't a comfortable number. It's a tight one. And that 3.9% figure assumes everything goes reasonably well. It doesn't account for a sequence of returns risks, which is the danger that poor market returns in the first 5 years of retirement permanently damages the portfolio. According to Morningstar, the highest safe rates tend to occur with a 30 to 50% stock allocation, precisely because too much equity in those early years raises the odds that you're selling shares at a depressed price just to fund living expenses. One bad stretch early, and the math on a $78,000 a year stops working. The point is not that $2 million is a bad number, it's a great number. The point is that $2 million without an income plan is a static pool that may start shrinking the day you retire. The question isn't whether you have enough saved. The question is whether you've engineered how that money flows and in what order. So let's talk about income as the engine and sequencing withdrawals to protect the portfolio. There's a specific way income needs to be sequenced in retirement, and most retirees never set it up this way. Fidelity's retirement research recommends covering essential expenses first with guaranteed income sources like Social Security, pensions, and any annuity incomes that you've structured. Discretionary spending then comes from the investment portfolio. That sequencing matters because it keeps you from being forced to sell equities during a market downturn just to pay the electric bill. Now, think of it this way. Your portfolio has 3 layers. The first layer is cash and short-term bonds. This funds your next 12 to 24 months of withdrawals, so you're never selling stocks in a downturn out of necessity. The second layer is intermediate bonds and income-producing assets. This refills the first layer over time. And then the third layer is your equity allocation, which stays invested and has the potential to compound. T. Rowe Price's retirement research is direct about this. Retirees should still lean into stocks for long-term growth, not flee from them. So the mistake isn't owning equities in retirement. The mistake is not having enough of the other 2 layers to leave those equities alone. When income is sequenced this way, the portfolio doesn't deplete, it cycles. The equity layer has the opportunity to keep growing because you never have to touch it at the wrong time. That's the engine. And it only works if the plan is built before you retire, not after the first bad quarter. So let's talk about the tax gap. Who's missing it and what does it cost you? I've seen people with $2 million or more saved for retirement still on track to overpay the IRS by $400,000 or more over their lifetime. Not because of bad investing, because nobody built them a plan that accounts for taxes, withdrawals, and Medicare costs at the same time. CPAs focus on last year's taxes. A lot of financial advisors focus on investments. That leaves a gap, and it's a real expensive one. Here's what most people don't see coming. The tax code doesn't get easier in retirement. It actually gets harder. Once required minimum distributions begin, let's say at age 73 or 75, then the IRS rules force you to take withdrawals from your pre-tax accounts whether you need the money or not. Those forced withdrawals show up as ordinary income, and they push your taxable income higher. And that can trigger higher Medicare premiums through IRMAA surcharges. It can cause more of your Social Security benefit to become taxable. And if your spouse dies first, the survivor files as a single filer, which means the same income now hits higher brackets. Researchers at Mercer Advisors call this the widow's tax penalty, and it's one of the most predictable, most preventable costs in all of retirement planning. The window to reduce that exposure is the years between retirement and when required minimum distributions begin. Greenbush Financial Group's research on Roth conversion strategy identifies this trough period as the single best window for conversions because income is lower and you can deliberately fill lower tax brackets. If you retire at 63 and required minimum distributions at 73, that's a 10-year runway. Every dollar that you convert from a traditional IRA to a Roth during that window is a dollar that will now grow tax-free and a dollar that won't generate a forced taxable distribution later. One advisor case modeled in Income Lab's 2026 Roth conversion guide found that a steady annual conversion strategy produced over $120,000 in lifetime tax benefits compared to doing nothing at all. The math compounds because the problem compounds, and the advisors most people rely on aren't looking at it. So there's a default assumption in retirement planning that your job after 65 is to get conservative, move to bonds, reduce risk, protect what you have. That framing is wrong, and it's expensive. A retirement that lasts 25 to 30 years has the same inflation problem as an investment horizon of 25 to 30 years. If your portfolio yields 3% and inflation averages 3%, your purchasing power is flat. You haven't lost money on paper, but you've lost ground in real terms every single year. That's why T. Rowe Price's retirement income research is explicit. Maintaining meaningful equity exposure in retirement isn't aggressive, it's necessary for portfolios that need to last. The Morningstar data on this is worth understanding. They found that the highest safe withdrawal rates in retirement tend to occur at 30 to 50% equity allocations, not at 10 or 20%. Going too conservative doesn't protect you from sequence of returns risk in any meaningful way because you've already or should have already addressed that with your income sequencing structure. What a too conservative allocation does is remove the engine that has the opportunity to keep the portfolio growing over time. The practical allocation for someone with $2 million who has income properly sequenced might look like this. Roughly 50 to 60% in equities across domestic and international broad market index funds, 30 to 40% in intermediate bonds and income-producing assets, and then 10% in cash equivalents covering near-term withdrawals. The equities stay invested. The cash and bonds handle distributions, and that's a portfolio designed to compound, not just to survive. The point isn't a specific number. The point is that asset allocation in retirement is an engineering problem, and the answer isn't always safer. Sometimes safer means growing so slowly you run out of purchasing power before you run out of time. So $2 million doesn't manage itself. It's provided the opportunity to grow because you sequence income to help protect the portfolio from forced selling, because you use the tax window between retirement and RMDs to reduce a lifetime of unnecessary taxes, and because you stay in growth mode with an allocation built to compound, not just survive. If you want help building that plan, you can schedule a call with our team at Cornerstone Wealth Management through the link in the description, or download our free ebook, Retire Happy, to get a step-by-step look at the framework we use with clients before they ever take their first retirement dollar. Don't wait until required minimum distributions force the issue. The window to get ahead of this is now. Thanks for watching.